Silver was seconds away from $70. Then, without warning, it stopped. Not a headline, not a policy announcement. Something else moved the market, and almost no one noticed it happen in real time. Welcome to Currency Arc Insight, where we examine the forces shaping gold, silver, and the global monetary system before the headlines catch up. Today, we break down what happened in the moments after silver's near miss with $70, and why the reversal may reveal more about the coming months than the spike itself. At 8:30 in the morning, the moment the consumer price index data hit trading terminals, silver did something it had not done in 7 weeks. It surged. Within seconds of the release, the metal jumped from its overnight range and kept climbing, eventually touching a session high of $66.91 an ounce. For a market that had spent weeks grinding sideways, the move was abrupt enough to draw attention across the entire commodities space, not just among precious metals traders. The timing was not incidental. Markets had been waiting on this specific data point for days, treating it as one of the clearest signals available for where the Federal Reserve stood on its next policy decision. When the numbers landed and were interpreted as tame, traders moved quickly, and silver was one of the first assets to react. But silver was not moving alone. Across the broader commodities landscape, a pattern was forming. Copper pressed to another all-time high that same session, continuing a streak that has become almost routine in recent months. The metal's persistent strength has been driven less by broad economic growth and more by tightening supply conditions, tied to infrastructure and grid demand. A dynamic that has quietly reshaped how traders think about industrial metals heading into the back half of the year. Crude oil moved in the opposite direction, slipping roughly 0.5% on the day. The decline was tied to easing tension around the Strait of Hormuz, where reports indicated that talks between Oman and Iran had advanced toward a possible resolution. A proposal reportedly under discussion would involve toll collection on shipping traffic through the strait, split between the parties involved, even though the waterway itself remains international. Diplomatic movement extended further, with Pakistan's interior minister traveling to Tehran for direct discussions with Iranian officials, underscoring how seriously regional governments are treating the situation. China, heavily dependent on energy flows through the strait, has been watching developments closely as well. Equity markets, by contrast, showed more restraint. The S&P 500 and Dow Jones Industrial Average both pulled back slightly during the session, a modest but notable divergence from the enthusiasm building in metals. That divergence matters. When equities hesitate while commodities accelerate, it often signals that traders are positioning defensively, favoring hard assets over paper ones, even as broader sentiment remains uncertain. Gold moved alongside silver, though with a steadier and more measured climb. The metal rose just under 1% on the day, adding just over $40 to break through the $4,400 level for the first time in the session. Platinum and palladium posted smaller gains as well, rounding out a broad-based rally across the metals complex. For silver specifically, the move to $66.91 represented more than a single-day spike. It placed the metal at a 7-week high, resuming a climb that had been briefly interrupted just 1 day earlier. That earlier pause had been attributed to a mix of factors, including strong underlying demand for precious metals and support from a weaker dollar and easing oil prices. In other words, the conditions for a renewed push higher were already in place before the CPI data even arrived. The report simply provided the trigger. What made the moment significant was not just the size of the move, but its proximity to a psychologically important threshold. $70 an ounce has loomed as a target level for months, discussed across analyst circles and investor communities as a marker of renewed strength in the silver market. Coming within roughly $3 of that level, even briefly, was enough to capture attention well beyond the usual base of precious metals watchers. Yet as quickly as the spike arrived, its momentum began to fade. Volume, which had surged in the immediate aftermath of the data release, started thinning as the session progressed. The sharp vertical move that characterized the opening minutes gave way to something closer to drift, a signal that the initial reaction, however dramatic, was already losing conviction. That shift set the stage for what came next. The same data that had propelled silver towards $70 was about to be read in an entirely different light, and the reversal that followed would prove just as revealing as the spike itself. To understand why silver reacted the way it did, it helps to look closely at what the consumer price index actually reported that morning, because the details mattered as much as the headline. The Bureau of Labor Statistics reported a seasonally adjusted increase of 0.1% in the consumer price index for July. Stripping out the more volatile categories of food and energy, core CPI rose 2% for the same period. On an annual basis, the two figures came in at 3.4% for the headline number and 2.5% for the core reading, both a tenth of a percentage point lower than June. Every one of these figures landed in line with consensus forecasts among economists, yet the market's reaction suggested that alignment with expectations was not the whole story. What mattered more was the direction of travel, and for the moment, that direction pointed toward cooling. Traders interpreted the data as evidence that the earlier burst of inflation, driven largely by energy costs, was beginning to moderate. That interpretation carried immediate consequences for the Federal Reserve's next move. A softer inflation reading reduces the case for an imminent interest rate hike, and metals markets responded accordingly. Lower rate expectations tend to support both gold and silver, since higher rates increase the opportunity cost of holding non-yielding assets. The moment the data crossed the wire, that calculation shifted in favor of the metals, and the spike toward 66.91 followed within seconds. Still, the reading held above the Federal Reserve's long-standing 2% target, even after the modest improvement. The tame monthly figures, paired with a similarly moderate June reading, suggested that the earlier energy-driven inflation surge was easing, though prices remained sensitive to conditions in the Middle East that could shift again without much warning. There is a distinction worth making here, one that separates genuine analysis from a surface reading of the headline number. Price increases and inflation are frequently treated as the same phenomenon, but they are not identical. Price increases can result from supply and demand imbalances, including disruptions tied to energy markets or global shipping routes. These pressures are cyclical by nature. Prices rise when supply tightens, and they fall again once conditions normalize. Inflation, in the stricter sense, refers to an expansion of the money supply itself, the actual increase in the number of dollars in circulation, whether digital or printed. That expansion dilutes the purchasing power of every existing dollar, regardless of what happens to any single category of goods or services. This distinction matters because government spending drives much of that monetary expansion. When the Federal Reserve issues more currency to meet funding needs, the value of each existing dollar is affected independent of whatever is happening with oil prices or supply chains. A single CPI report blends both dynamics into one number, which is part of why headline inflation data can be misleading if taken at face value. For an audience focused on wealth preservation, recognizing that difference is not a minor technicality. It shapes how seriously any single data release should be weighed against the broader monetary backdrop. That broader context also explains why some caution is warranted about how long this particular reading's influence would last. Price pressures tied to energy have shown signs of returning, with certain readings pushing back into higher ranges that have not yet been reflected in the official data. If that pattern holds, the next CPI report may not repeat July's moderation, and could instead show inflation holding steady or ticking back upward. For the moment, though, the market treated the data as a green light. The tame reading shifted sentiment enough to move the FedWatch tool's probabilities, a shift that would ripple through the rest of the session and shape how traders positioned themselves heading into the next major data point. But the same data that fueled silver's push towards $70 was about to work in the opposite direction, once a separate and more immediate factor entered the picture. That factor was the dollar, and its return to strength in the hours that followed would prove to be the real turning point of the day. The turning point did not come from a headline, it came from the dollar. In the hours following the CPI release, the U.S. dollar index staged a quiet but decisive recovery. Earlier in the session, the index had slipped more than 0.1%, on pace for its first daily decline in 3 sessions. That early weakness had been part of what fueled silver's initial surge, since a softer dollar typically makes dollar-denominated metals more attractive to buyers holding other currencies. But that weakness did not hold. By the time the trading day matured, the dollar had reversed course entirely, climbing back above the psychologically significant level of 100 on the index. That single shift changed the entire complexion of the session. As the dollar strengthened, silver's gains began to erode. The metal, which had touched $66.91 earlier in the day, settled back to $65.38, still up 0.8% on the day, but a fraction of the move it had briefly achieved. The retreat happened gradually rather than all at once, unfolding over the course of the afternoon as buying pressure thinned and the market absorbed the dollar's renewed strength. Volume told its own part of the story. In the immediate aftermath of the CPI release, trading activity spiked sharply, consistent with the market reacting in real time to fresh information. But as the session wore on, that volume steadily declined. Lower volume trading tends to drift rather than trend, and that is roughly what happened. Prices floated modestly higher in the final stretch of the day, not because of renewed conviction, but simply because thin trading conditions allowed for small upward drift without any real catalyst behind it. What makes this reversal significant is the contrast it drew between gold and silver. Gold continued climbing even as the dollar strengthened, rising just under 1% on the day and breaking through the $40,400 level. That divergence is worth sitting with. If a stronger dollar were the dominant force across the entire precious metals complex, both metals should have felt similar pressure. Instead, gold pushed higher while silver gave back much of its earlier gain. That split suggests silver's rally may have been more sensitive to short-term positioning and momentum trading than gold's steadier, more structurally supported climb. This is not a minor technical detail. Silver has a well-documented tendency to move with more volatility than gold, both on the way up and on the way down, in part because of its smaller market size and heavier reliance on industrial demand, alongside its role as a monetary metal. That volatility can work in an investor's favor during strong rallies, but it also means silver's spikes can prove less durable than they initially appear, particularly when a fast-moving variable like the dollar shifts direction within the same trading session. The dollar's reversal itself deserves attention beyond its immediate market impact. A currency that weakens on soft inflation data and then strengthens again within hours reflects a market still working through conflicting signals about the path ahead for interest rates. Traders were not simply reacting to the CPI report in isolation. They were recalibrating in real time as new information about Federal Reserve intentions continued to filter through the session. And that recalibration ultimately favored the dollar over the metals by the closing bell. For investors watching silver's approach towards $70, the day's reversal offers an important lesson about how quickly sentiment can shift, even without any change in the underlying fundamentals. Nothing about silver's supply and demand picture changed between the morning spike and the afternoon pullback. What changed was positioning, and positioning can move faster than fundamentals ever will. The question now is what this reversal signals about the weeks ahead. If a resurgent dollar was enough to cap silver's advance so close to a major psychological level, that raises real questions about how much further the metal can climb without either a sustained dollar decline or a fresh catalyst strong enough to override it. That question leads directly into the next piece of the story, one that centers not on a single data release, but on where the Federal Reserve itself appears to be heading over the months ahead. Behind every move in the metals market that day sat a single unresolved question. What will the Federal Reserve actually do next? And the answer, as reflected in the FedWatch tool, shifted meaningfully in the hours following the CPI release. Before the data arrived, expectations for the September 16th Federal Open Market Committee meeting had been trending toward a more even split between holding rates steady and moving forward with another quarter-point hike. Once the tame inflation reading landed, that balance shifted decisively. The probability of a hold climbed to roughly 60%, while the odds of a quarter-point increase fell to just under 40%. In practical terms, the market had concluded that the case for tightening policy further had weakened, at least for the immediate meeting ahead. October told a different story. Looking further out on the calendar, the probabilities leaned back toward a hike, with the market still assigning a majority likelihood to a quarter-point increase at that later meeting. But even there, the gap was narrowing, edging closer to an even split as the weeks progressed. That narrowing matters. It suggests the market is not fully convinced the Fed's tightening cycle is finished, even as it grows more confident that any further move will be delayed rather than abandoned. This distinction between a pause and an end to tightening is central to understanding how gold and silver behaved that day and how they are likely to behave in the weeks ahead. Metals tend to respond favorably to reduced rate hike expectations because lower rates diminish the opportunity cost of holding non-yielding assets. But a pause is not the same as a pivot toward cuts. The market was pricing in a delay, not a reversal, and that more measured interpretation helps explain why the initial spike in silver gave way to a more modest, uneven close. There's also a broader pattern worth noting. Each of the last several major economic data releases has followed a similar rhythm. A sharp initial reaction in the metals, followed by a partial retracement as traders digest the full implications of the data rather than just the headline number. That rhythm reflects a market still searching for conviction, unwilling to fully commit to a sustained rally until it sees more consistent evidence that the Federal Reserve's tightening cycle has genuinely run its course. That search for conviction sets up an important dynamic heading into the fall. If the current pattern holds, with the Fed continuing to hold rates steady through September while leaving the door open for later action, gold and silver may find themselves in a holding pattern of their own. Absent a fresh and forceful catalyst, whether from further escalation around the Strait of Hormuz, a sharper than expected inflation surprise, or a shift in the dollar's trajectory, the summer's rally could plateau rather than continue its climb toward the levels many investors have been watching for. That possibility, that this could mark something closer to a seasonal top rather than the start of a sustained breakout, is not a call to abandon the broader thesis behind gold and silver. It is a reminder that markets rarely move in a straight line, and that even strong multi-month trends are punctuated by periods of consolidation, particularly when a single data point like the Producer Price Index due out the very next day carries the potential to reshape sentiment all over again. The Producer Price Index is worth flagging specifically here because some within the Federal Reserve itself have pointed to it as a more reliable gauge of where inflation is truly heading than the Consumer Price Index. If that report tells a different story than the one the market absorbed today, whether firmer or softer, the probabilities embedded in the FedWatch tool could shift once again, and with them, the near-term path for gold and silver. What today's session ultimately revealed is a market caught between two competing forces. a genuine, data-supported case for a Federal Reserve pause, and a currency market still capable of asserting itself forcefully enough to cap even a well-supported rally. Both forces remain in play heading into the final months of the year, and neither has decisively won out. That tension between policy expectations easing on one hand and the dollar reasserting itself on the other is precisely what investors need to understand if they want to interpret whatever comes next with clear eyes rather than reacting to each individual headline in isolation.